So you're thinking about moving to Atlanta and you're wondering, like, should I buy a home? And I've heard that interest rates are going up, or I've heard this term like purchasing power or buying power thrown around. And maybe you just really want to understand like what that means and how it affects you. And so if you've got any interest in understanding how that affects your ability to buy a home or moving to Atlanta, well, then you're going to want to stick around for that. And we're going to get after it right now. Hey, if this is your first time to the channel and you want to know everything there is to know about eating, sleeping, working, playing, the good and the bad of living in Atlanta, Georgia, or any of the surrounding suburbs, well, then subscribe below and ring that bell for notifications so you can be the first to know about the current market here in Atlanta. My name's Denny. The team and I get calls each and every day from people just like you looking to make the move to Atlanta, and we absolutely love it. So whether you're moving next week, next month, next year, or anytime in between, call us, text us, email us. We'd love to hop on a Zoom and help you make a smooth move to Atlanta. As I mentioned in this video, we're going to talk about interest rates. Like, what are they? How are they set? How does that affect you? Should you buy now? Like all of that kind of stuff. And so just to kind of give you the 10,000 foot view, you don't need to, get a PhD or become a mathematician. But what happens is the federal government sets the Fed fund rate. And what happens is when they change that amount, and it's really what they will lend to banks for or lend to lenders. And so if the government says that they're going to lend money to the banks at 5%, well, the banks take that money that they pay 5% for, and they look at all the people that want to borrow money and their credit worthiness and how risky or unrisky or little risk, how much or little risk they think these borrowers are, and then they add a spread to it. And the worse your credit and the riskier you are as a borrower, the bigger the spread that they add on top of the Fed rate. And so, if it's set at 5, maybe rates are 7 to 23% or whatever. We've gotten accustomed to rates as low as the 2s. And so the Fed had lowered the rates enough to where they were lending at historically really low rates. By the way, there are a handful of countries around the world that actually have negative interest rates. Like, most people go, well, how's that work? If the government said, hey, bank, we'll pay you 2% to take this money, and the bank then turned to you and said, well, we'll give it to you for 0.5% if you'll borrow it. Well, then the bank still keeps the spread. They pay you and the government pays them even more. Like, that's literally the government is trying to financially engineer or eradicating bubbles, eradicating depressions, eradicating economic variability, all of that stuff. So you just can't. There's always going to be ups and downs, but they're trying to smooth it out. And so what happens is when we have an inflation like we've had, homes are getting more expensive and everything else is getting more expensive. One of the ways that they can try to reduce inflation and bring the prices down a little bit or stabilize it from this runaway price increase, because the market, real estate prices went up 15% nationally across the country last year, and they in 2021, and they went up 22% here in Atlanta because there's a lot of movement into Atlanta, this migration from the West Coast to Northwest, the Midwest, and the Northeast all into the Southeast, and Atlanta's got a really great place to live. So a lot of people are coming here, which is why you're watching this. But when they take that rate and they move it from 2 to 2.25 to 2.5 to 2.75, well, the rate the banks lend at, the end consumer, that moves up from, 2.25, 2.5, 2.7, 8, 9, 3, 3.5, 4. And so as the Fed charges more money for the money that the banks borrow, the banks then charge us, the consumer, more money for the money we borrow from them. And so that's how rates are moved. So when the government thinks that inflation is a problem, they raise those rates so that they want to try to slow down the appreciation of homes. And so here's what that would look like tangibly to you for your mortgage. I'm going to give you a couple of different scenarios, but buying power is how much home your dollar will buy, or purchasing power. Those are a couple of terms that are used. And so a $500,000 home, and let's say you had 20% to put, there's a lot of people paying cash, putting down 50%, using the equity out of their current home to buy the new home or go into the new home. Or there's people putting down no money for VA loans, or 3%, 5%, 10%. I'm just using kind of a conventional loan, 20% down, which means there's no PMI. And I can't guess what the taxes are going to be, or what the HOA is going to be, or any of that stuff. And so this isn't going to be exact, but it'll be pretty close. It'll be close enough to give you some really good insights into how this works. So $500,000 home with a 20% down payment is $100,000. So you're financing $400,000 in this example. And in that example, a 3% rate without taxes, without property taxes and insurance and HOA, without all that stuff, just the principal and interest is $1,686. So $500,000 house, $100,000 down payment, $400,000 borrowed, 3% is $1,686. That rate goes from 3% to 4%, and that payment goes from $1,686, the principal and interest, to $1,909. That is a $223 per month increase for the exact same priced home. And so that's really how rates can affect your ability to buy a home, or as much, which means your budget might go down. Set another way, and I'll use a different example, and maybe I'll include some of that other stuff, the taxes and insurance, and I'll just guesstimate. A $500,000 home at 2.6% is about $2,000 a month. So if your budget's $2,000 a month, you can go out and if you can get 2.6%, you can get a $500,000 home. Now, the same person with the same credit worthiness and the same score and the same qualifications, if the Fed raises rates, and so then the bank raises rates, and that goes from 2.6 to 3.6, well, then that same person with a $2,000 a month budget at 3.6 can only buy a $458,000 home. So you're talking about $42,000 less in purchasing power. And so when rates are going down, it really works for you to be able to spend more on a home. That's what causes some of this appreciation. And that's why they raise the rates, to try to slow that down. And so you could find yourself, in terms of, like, I'm going to do an entire video on this, but to kind of steal some of the thunder, you could find yourself in a situation where, rates are going up and prices are going up. And if that's the case, is now a good time to buy? I don't know. I asked the people that thought about it last year, and now we're looking at higher rates and higher prices. And so what's the next year going to hold? Is it going to be higher rates and higher prices, lower rates and lower prices? That's the $1 million question. And that's why you should subscribe and ring that bell, so you get notified when we release new videos and continue to unpack some of this. So, if you have questions or comments about this particular topic or anything else, feel free to leave those below. And like I said, subscribe and ring the bell for notifications, so you know when we release videos. And if there's something we haven't covered, we would love to. If you're moving, next week or next year, anytime in between, please do call us, text us, email us. Would love to hop on a Zoom, help you make a smooth move to Atlanta. And more importantly, until I see you here in person, hopefully I'll see you on the next episode. Take care.